Now, the technique number one that we are starting from is known as payback period. As I mentioned, there are three things that we'll be covering in payback. The first is definition of payback, what actually payback is. So payback is the time that represents break-even for a company. It actually represents the time when the investment will show its break-even. So it actually measures the time where the investment will reach its break-even. So this is a payback period. Second thing that we need to cover is the calculation of payback. So let's move towards calculation, but in last, we will be covering the advantages and disadvantages of payback. So we'll be covering advantages and disadvantages of payback at the end. Let's start with calculations first. So in calculations, you need to remember that there are two areas that you need to learn. First is calculation in case of even cash flow. Calculation in case of even cash flow. And second is calculation in case of uneven cash flow. So first is even cash flow and second is uneven cash flow. Now what is even cash flow? And yes, remember this is a cash flow based technique. So you need to keep this in mind. This is a cash flow based technique, okay? So there will be everything which is cash based. In case of even cash flow, we need to remember a formula, a very simple formula in case of even cash flow that we need to remember. And that formula is, in order to calculate payback, the formula is investment divided by cash flow per period. So it's a very simple formula and you can note this formula as well. Investment divided by cash flow per period. So what is even cash flow? When the cash flow is same every year, every month, every period. So this is even cash flow. For example, you made an investment in a project and the investment that you made in a project was for 10 years, let's suppose. So if the investment was for 10 years and every year the cash inflow is of equal amount. So this is the main thing, that this cash flow is constant. So when this cash flow is constant of equal amount, so this is known as even cash flow. In case of even cash flow, you have to use this formula. So do check in a question that whether cash flow is even or that cash flow is uneven. Let's move towards some exercise here to actually demonstrate how actually we will be calculating the payback period in case of even cash flow. Let's see what the question is asking. Company made an investment of 300,000 in a 10-year project. The cash inflow per year will be $50,000. Now, the first thing, as I mentioned, that you need to consider is whether the cash flow is constant or not. Now, if you think the cash flow is constant, so remember the formula that we have to use? Yes, the formula that we have to use is of even cash flow. So, what the formula was, you can see the formula is investment divided by cash flow per period. The cash flow is constant. So let's quickly work out the payback in such a situation. So coming back to the question, quickly work out the payback. Now, the amount is 300,000 divided by the cash flow per period is how much? 50,000. So what is the answer of payback? It's simple. 300,000 divided by 50,000 per year cash flow makes 6 years. So I hope people, this is clear. VIFHEians, this is clear. It's very simple to figure out. As you can see that 300,000 is basically the investment and the cash flow, as I mentioned, is 50,000 per year. It's a constant cash flow situation. So the payback answer is 6 years. Hope this is clear to every one of you. So certain things that you have to remember when you're solving a payback situation, and I call these as $1 million points. So I want you to note those $1 million points as well. And the points that you need to remember are in front of you. The first thing is, see whether it's a constant cash flow situation. Yes, if it is a constant cash flow situation, go for the constant formula. You need to remember the formula. Then you have to see whether your answer will be given in years or it will be given in months. So whether you have to give answer in years or months, so that's what you have to consider. So you see, we have to give answer in years. So then we have to do working for years. And if it was asking for months, so it's very simple. We can easily work out in months, as I will explain you right now. So this is what you have to see, that answer has to be given in years or in months. Now, if the cash flow is given in years, as this is given in years, if the cash flow is given in years, are you listening what I'm saying? If the cash flow is given in years, so the answer will come in years. And the cash flow is in years. To convert this into months, I will multiply this with 12. Simple. So as I'll multiply this with 12, so the answer will be 72 months. So the answer is in 72 months. So 6 years. And when it comes to months, so 72 months. So I'm sure this is pretty much clear. So this was the first situation that dealt with payback in case of even cash flow. I hope this is pretty much clear to all of you. Moving towards the second situation. And that second situation is known as uneven cash flow. So what we need to do in case of uneven cash flow. For uneven cash flow, we need to follow an approach known as cumulative approach. So this is a cumulative approach that we have to follow in case of uneven cash flow. Now, what is cumulative approach? I'll explain you with a question here with a very good example. But what is uneven cash flow? So this is clear. When the cash flow is not constant. So when the cash flow is not constant, which means every year the cash flow is changing. So in that particular case, we have to use cumulative approach, and according to cumulative approach, we can get a payback answer in case of uneven cash flow situation. So let's now illustrate that situation as well. The company made an investment of $400,000